after the auspicious puja which we just had a little earlier today, the respected speaker and our past president of BCAS, Himanshu Bhai Kishnadwala, Vice President Kinjal, past presidents Pranay Bhai, Abhay Bhai, Govind Bhai, Rajesh Muni, members both online and offline, and others. I think we had a record number of registrations of 1300. Let's see how many actually join. Even if half of them join or even 40% of them join, it is still, I would say, a super start, I think, to the BCAS year 25-26, and people even here are still walking in as we are speaking. Being myself an audit and accounting professional, so I am particularly happy that this lecture meeting is being conducted by Himanshu Bhai. I had booked this time nearly 3 months in advance, and he immediately agreed within half an hour. The topic which has been chosen is an annual feature which he virtually almost takes every year. But this time, there is an added dimension to that, in the sense that now there is a format and there is guidance laid down by the ICAI via a guidance note, even for non-corporate entities. So bringing about a greater formalization and more professionalism in the non-corporate sector. So that will also be covered along with the important developments for the corporate sector. Because as we all know, auditors are now facing increasing number of challenges. And this is also now one more challenge where even earlier non-corporate entities, there wasn't really that much oversight. Maybe the level of oversight will not be to the same degree as like a QRB or a NAFRA. But there will still be some greater accountability now even for the auditors undertaking audits of non-corporate entities. And the other side, the accounting professionals or the accounting practitioners, people who are actually preparing the accounts in the non-corporate entities, will now need to follow stricter discipline in terms of complying with the disclosure requirements, which are almost now on par with the other corporate entities in terms of the format, which is aligned with, almost virtually aligned with Schedule 3. So these and various other aspects, I'm sure, will be covered extensively by Himanshu Bhai in his own inimitable way. Since quite a lot of you who have enrolled and registered today would be non-members but who are chartered accountants, I would like to just take a few moments to explain to you what BCAS is. Bombay Chartered Accountants Society is India's largest and oldest autonomous voluntary body of chartered accountants, which was set up only 6 days after the ICAI. It has now grown into a pan-India organization, having members across 400 towns and cities. Our membership currently is at its highest ever, and it is now almost touching 11,700 members across 400 towns and cities. So it is really no longer Bombay. Bombay is just the name, but it is now full India, or what I call as Bharat now instead of Bombay. Our prime focus is to be a learning centered organization offering various programs under the guidance of various technical committees, whether it is accounting or auditing, direct tax, indirect tax, international tax, corporate finance, and also some non-technical committees which provide a balance, which help to achieve a work-life balance. So it is not only all just technical, but we also look at the holistic development of the fellow professionals through our seminar committee and through our HR committee. The next area of BCAS is its publications. We regularly come out with publications, again, both on technical and non-technical topics. We have some things, we have a publication, Thought Mailers, which is a compilation of the articles by various authors on various subjects, not necessarily technical. There is a book, Gita for Professionals, for example, which is now in its 7th edition. So we also look at the spiritual aspects also. But most important is the priced publication of ours, which all of you would be aware, is the BCAJ, Bombay Chartered Accountants Society Journal, which is now almost 60 years old. It is a sought after publication where even not only the chartered accountants, but even people from other professional fields and also government officials and bureaucrats and similar regulators also refer to this publication. And this is the area where we have a separate class of journal membership, where even non-CAs can be only members of the BCA journal, only journal members. And we are also launching a new class of members only for the e-journal through a platform which I will just be shortly sharing with you. So, and the last area where BCAS is involved is in advocacy and representation. Representations, you all may be knowing, all organizations give representations on things like the annual budget or when there is some regulatory change or whether government is proposing some new legislations. So we make representations. But apart from representations, we are also now getting more and more into advocacy in the form of research, in the form of collaborations with certain other like-minded organizations, both professional and industry bodies, to act as a think tank, and also even with a lot of regulatory bodies where they seek our assistance and research on certain topics of contemporary interest. There are certain programs which are only for the members at discounted rates. So these and a lot of other advantages are there for you to become a member of the BCAS if you are a chartered accountant. So there is nothing which is stopping you. We are there to welcome you with open arms, because I'm sure if you join, you will not regret this decision for your life. You will be a life member. And the life membership fees are pretty competitive. So request all of you who are CAs, members of the ICAI, but who are still not members, please join at the earliest, because you are otherwise missing out something important and exciting in your professional journey. So this is as far as BCAS is concerned. Before we start off with our actual lecture and the introduction of the speaker, see, there are a lot of initiatives which the BCAS has taken. And one of the most important initiatives which started last year under the immediate past President Anand Bhatia, under his guidance and stewardship, is what we call as the BCAS Academy. It is a self-based learning platform wherein not only it would be a repository of all the programs which the BCAS has done, which will be available to the members and in certain cases even to non-members, both on a free basis and on a paid basis. Plus, it will also eventually act as a one-stop station to enable members to directly register for the events. Plus, whatever long duration and short duration learning courses, certification programs, and all which the various committees are there, members can or non-members can enroll for all these programs, and certificates will be also issued. So each person can track its learning hours, and also it would act as a community, as a broadcast group where members also can interact amongst themselves. So these are various features. So we would like to just, it was the soft launch of this was done at our AGM. So those of you who were there at the AGM may have probably seen that video. But after that, there have been in the last 2 weeks, final upgradations are done, and now we are ready to launch this on a full scale going forward. So we would like to just play that video. If you can just the 2-minute video. Intent to develop this over a period as a distinct brand and identity. Is the website which address which you can access it. So this is really now the future. This is just the beginning. So without much ado, I would now request Vice President Kinjal to please introduce the speaker. Though, of course, most of you would know him, but still we have to go through the formality. So thank you and all the best for today's lecture meeting. Thank you.
Hello, friends, and a warm good evening to the speaker, the president, the dignitaries on of the dais, and the participants. Friends, Himanshu Bhai within the BCAS circle needs no introduction. As far as he has been concerned, he has been actively involved in various activities. But since we have a large members attending online who may not be more acquainted with BCS, and for the benefit of them, I introduce before you CA Himanshu Kishnadwala. He is a fellow chartered accountant and a rank holder in his CA exams. He is a senior partner of CNK and Associates Chartered Accountants Mumbai, and he oversees the audit and assurance practice of the firm, more particularly the India's IFRS US GAAP implementation, investigations, due diligence assignments, and also oversees the sustainability and the ESG practices, uh, which includes the process setup, automation, assurance, and BRSR implementation. He is also the ex-senior lecturer in accountancy and computer system at the NM College, and a co-author of the books on accountancy and financial management, which forms part of the syllabus at the Mumbai University. His involvement with the CA Institute includes being member and a special invitee to various committees like the Accounting Standard Board, the Indian AS Implementation Committee, the Expert Advisory Committee, Research Committee, and is also part of the various groups for Financial Review Report Board and the guidance note on Schedule 3 of the Companies Act, the revision standards of the auditing, and the Economic Policy and Legislative Consultation Group. His involvement with BCS includes his presidential term at BCS in 2006-7, the chairman of the Accounting and Auditing Committee, which is very close to his heart and is always active and available whenever it is required at BCS. Also, the compiler of the column from the published account, which appears on a monthly basis in the BCAS journal and has been contributing it for more than 25 years consistently. He has delivered various lectures at seminars, conferences, and presented papers on articles for ICI, BCAS, CTC, IFAC, etc. He is also the director and member of the audit committees of various companies. Friends, before I ask him to start his presentation, may I now request the President BCS, Zubin Bhai, to present a memento to Himanshu Bhai as a mark of our love and affection. Thank you, Zubin Bhai. May I now request Himanshu Bhai to start his presentation.
Right. A good evening to all of you. The the president, vice president, the other past presidents, my friends, colleagues present here and who have joined online for this session on the developments or reporting requirements for this particular year 24-25. Now, when this video was being played on the BCAS Academy, today's session was also there in one of the pictures. So I thought they have already put up the whole thing there, so I need not. In any case, we will have to go through this. I'm sure they are going to put this up also once the session is over in that sense. But today's session, when I was talking to my assistants who were preparing this presentation, they were asking me what all to cover because it's such a diverse thing to cover in a short span or something. So I told them simply you cover something which we call generally as kal, aaj or kal. So something of the past is there which is irrelevant. Lot of things on the arch thing, the current thing, and some things on the kal thing which is going to come in future. So kal, aaj or kal. That is what I told my team. Prepare something on this. The percentage is not obviously 1/3 each, but it would be maybe 10, 10, and 80 in that sense. So let's start with this kal, aaj or kal presentation. So the whole presentation is divided into three broad aspects. One is on corporate entities, and again in corporate entities you have listed entities, non-listed entities. Now listed entities, obviously the reporting dates have gone. 31st May is the last date where the reports have to be adopted in that sense. But nevertheless, there are some important things which still keep on happening because the first quarter has already come for those listed companies. Non-listed companies, some of them are even bigger than listed companies. So though they may not be governed by SEBI in that sense, lot of rules of SEBI may still be relevant for them, though not applicable for them, may be relevant for them. So we will cover some of that. Then we have non-corporate entities, which will be LLPs, firms, proprietorships, NPOs, and various other things which are listed in the guidance note of non-corporate entities. And few other important points. Now that important points is something what I thought would be relevant from a yesterday perspective and maybe from a future perspective also. So this is what we are going to cover today. The first is obviously corporate entities. And when I take corporate entities, obviously we are talking of Companies Act. Now, two important developments for all companies which have happened is just taking two of the important amendments. One is a mandatory dematerialization of shares even for private companies. So when you are reporting even as an auditor of private companies, this is something which you will have to guide the companies because earlier the last date of doing this was 30th September, which finally got extended to 30th June. There are some exceptions available for say small companies or others, but otherwise even for private companies, demat of shares is almost mandatory for them. So in case when you are reporting and it's an important reporting aspect of whether all provisions of the Companies Act have been followed by the company, this is one thing which you may have to be careful about or at least guide the company in that sense about this mandatory demat for private company shares also. Then in the last maybe few weeks, a lot of these forms have changed. This form 1, 2, 3, 4 all have changed in the last few weeks. All of them deal with auditors, auditors appointment or resignation or maybe removal of auditors, intimation to ROC, reporting on the fraud. They have all been revised and they have all been made more digital. Earlier they were more maybe manual, but now they are made more digital where even for if there is a fraud, you have to write various reasons digitally and upload them in the respective columns or something which is there. So two things which I thought would be important from our appointment perspective also about Companies Act amendments which are there. The amendments in the Companies Act which deal with say accounting or maybe auditing are anyway covered separately because even a small change in accounting standards or auditing standards ultimately has to go through the Companies Act because they have to be notified under the relevant sections and the rules of the Companies Act itself. So if you look at the accounting standards applicability where there is always some change or the other happening, but before that and we will have this slide coming again when we go to non-corporate entities. So this is how the accounting standards really apply. You have got Indian accounting standards which are notified by MCA. You have the normal accounting standards. So non-Ind AS accounting standards again notified by the MCA. You also have accounting standards notified by ICAI. Now, the first two set of standards notified by MCA apply to corporate entities. The third set of standards apply only to the non-corporate entities which are given by ICAI because for non-corporate entities there is no governing statute in that sense. So if the Partnership Act or the LLP Act doesn't govern or have anything about standards or the formats or anything. They are all getting really from the institute itself or the guidance notes. Now, in terms of number of standards, if you look at Ind AS standard, there are 40 standards. There are more coming in future, but as of now, 40 standards. MCA accounting standards are 27, and the institute accounting standards are also 27. Now this 27 is more or less identical, but there are few changes, very minor changes, but there would be few changes which would be there in these two 27 standards applicable to either non-Ind AS companies or to non-corporate entities. Okay. Now, how does the standards apply for corporate entities? So, if you are an entity whose net worth is less than 250 crores, you go with those 27 standards. If you are an entity which is more than 250 crores or a listed entity or about to be listed entity, then you go with the Ind AS, which are 40 in number in that sense. Okay. And there are obviously some nuances that if you are a subsidiary or a joint venture of a company which is already under Ind AS, then those entities also have to follow Ind AS and all. Now, this is all in the normal course which we are used to in that sense. So, when you come to some changes which have come in the Indian accounting standards, one of the major change which happened last year was this introduction of Ind AS 117. So, this came in on 12th August 24 and is applicable from 1st April 24. Now, if the name says insurance contracts, then you will feel that it is only for insurance companies. However, this standard applies to even all entities, even other than insurance companies. And there are several items within the standard where non-insurance companies also will have to keep track about in that sense. So there are some things which are there in 115, which are there in 109, which automatically will have to apply 117 unless they are specifically exempt by the standard, which is the 117 in that sense. Now, since this standard was notified, IRDA, which regulates insurance companies, suddenly found out that insurance companies are not prepared for this standard, because this can have huge implications for the insurance companies and the entire sector as such. So they told MCA, and MCA came out with one more notification 1 month down the line, saying that this standard does not apply to insurance companies till IRDA also notifies it. So as of now, you have 117 which is notified for all companies except insurance companies. Still IRDA notifies, and IRDA does not have a chairman since last 4 months. So so that is one area where I think the insurance companies are playing it easy as of now. And just before 10 days, we had in the first week, we had a program on Ind AS 117 at BCA, a very well received program. It was in the very same venue. I think that would have gone on the BCA Academy by now. And that was a good program. If you are interested, have a look at that material. But 117 is a standard where it applies even to insurance contracts for non-insurance entities. And though there are some exclusions which are there, and those exclusions clearly say that if this aspect is there in your company, then apply 115, don't apply 117, or apply Ind AS 38, or apply 116, and so on. So that is very clearly mentioned in 117. We are not going through the entire nitty-gritties of 117 because that's a whole day by itself in that sense. And as Abhay would say, who chaired that program that day, this whole day program was only an initial starter to the whole event of 117. There are multiple programs being planned now for 117 down the few months which are there. Similarly, if you have say something like a contingent consideration, which is something like a insurance, you will have to cover it in 103 and not directly in 117. There would be 19, there would be 102 for ESOPs, which would get covered, and so on and so forth. So insurance contracts, if you are a entity, a corporate entity which follows Ind AS and you have a lot of financial instruments and there is some insurance element in any of those financial instruments, then you will have to consider whether 117 changes apply to you or not. One thing which I can easily tell you is say something about guarantees. A lot of companies issue guarantees on behalf of their subsidiaries and others. Now, if there is a guarantee, you will have to account for a guarantee in terms of 109. A lot of companies used to take a stand that a guarantee is something like an insurance contract and I will apply 104 to it. which is the earlier standard on insurance. Now, if that be the case, and if you are applying 104 so far, now you will have to switch to 117 and then really decide whether you can still not value that guarantee and follow 109 in that sense. Okay, so guarantees is a classic example where 117 may get applicable unless there is a specific exemption which is available in that particular standard. And if that exemption is there, then you will have to start following 109, which means that exemption which you were earlier using for 104 will not be available now. So non-insurance companies that have previously not applied insurance accounting are not necessarily exempt from applying insurance accounting in the future. Where non-insurance entities conclude that they've issued contracts within the scope of 117, they will have to do a lot of changes in their IT systems, the risk control matrices, governance structures, presentations and disclosures. A whole new set of presentation disclosures come in 117. Insurance companies obviously need to closely monitor the IRDA. What IRDA has done is they have said, as of now, don't adopt 117, but prepare dummy accounts using 117. So do a dry run, as they call it, using 117. So they are preparing multiple sets of accounts, and all insurance companies and professionals who are working with those companies are anyway busy with 117 in that sense. Okay. The next standard change is in 116, which is on leases. This is a very specific change, sale and leaseback with variable lease payments. So if you have a sale transaction which is considered as a sale and leaseback as per the standard 116, and there is a variable payment in that sale and leaseback arrangement, this standard applies to you in that sense. And there are multiple things which you will have to now follow. It is making the standard little more complex than it was before. In any way, 116 was a complex standard. If you have a sale and leaseback, which is a variable thing, it becomes still more complex. And 116, you may actually need to use a lot of Excel formulas or some tools to decide how do you recognize the lease payments and how do you break it up in terms of the ROU asset or something in that sense. So initial recognition of the liability, subsequent accounting, estimated lease payments and actual lease payments, all that will have to be factored in, because when you have variable lease payments, they may not be determined. It may be determined based on some future events also. The next change, which is actually coming from next year, is on this foreign exchange rates. It starts really from April 25. So this really is for foreign exchange translations where you have a currency which is not easily available in that foreign country. You may have a lot of countries in Africa where you may have a lot of money lying there but may not be able to bring it here. Now, so far, there is no separate treatment provided for it, because you just take the spot rate which is available theoretically and account for it accordingly. Now, the standard has come up with some nuances which says, is the currency exchangeable into the other currency at the measurement date for the specified purpose? So, are you able to remit the currency? Are you able to immediately bring it here? Is there a spot rate available which is a stable spot rate or something? You will have to ask all these questions which are there. And when you are looking at this, they are saying that if there is an administrative delay, that is permitted. So if you go to a country like, say, Nigeria, they will give you a spot rate, but there is a delay in remittance because there is an administrative delay. So that is permitted. In between, the spot rate may change also. So ability to obtain the currency is essential and not the intent. Currency is exchangeable at measurement date for specified purpose. Exchange transaction should create enforceable rights and obligations, and ability to obtain more than insignificant amounts. You have a lot of countries in Africa where there are two exchange rates. One is what we call it the official rate, and the other is the official unofficial rate. So if you go to a central bank also, they will give you two rates, that we have got this much currency which is backed by something. So we will give you that much, but we can also give you some other currency which is a higher rate, which is the official unofficial rate, as they call it. So we'll have to figure out which rate to apply, which is the spot rate in that sense in those countries. Okay, so how do you estimate a spot exchange rate? I think this presentation will be put up, I believe, tomorrow on the website. So no need to, yeah. So you have to estimate the spot rate. Is there a spot rate available for similar transactions? Is it easily possible to remit that currency? Now, if you are not able to fulfill all these things, then you may have to take a different exchange rate. And then the financial statements will carry a lot of disclosures saying that though you have got, say, a bank balance of $1 million in that country, it is not possible to bring it back so easily. So we'll have to consider all that for the reader to find out whether your currency is there, but it is not really available for use in that sense. Okay. Come to the next thing, which is your audit methodology and the standards on auditing, which is there. Now, I initially wanted to cover only the new standards on auditing which has come, but we added this few slides on audit methodology because over the last 1 or 2 years, a lot of focus has shifted on the audit methodology from what we have been doing initially. And that is why this typical audit methodology, which is now acceptable to maybe a peer review, to a QRB, or even the NFRA. Whenever you do an audit, you have to demonstrate these three things now. That there is audit planning which you have done, there is audit execution which is done, and there is audit reporting which is done. Now, in the past, what we have seen is, and I am sure all of us have experienced this, whenever we have people free sitting in the office, we say, please go and start this particular audit or go and finish 3 months audit or something. So even before planning, we start execution. Now that is something which is frowned upon by, now even a peer reviewer will look at this. NFRA certainly frowns upon these things, or a QR, a quality reviewer, reviewer who can come. So audit planning is one of the most important aspects, and without planning, it is now almost certainly proved that you cannot conduct a effective audit. So involves extensive discussions in understanding the client, his business, the risks involved, mitigation, challenges, deciding the team size, composition, and so on. And typically, as a lot of this orders of NFRA say, 25 to 30% of your total audit time has to go only in audit planning. That will involve visits to the client, visits to the factory of a client, understanding what is there, selecting a team which is well versed with it. So if you are auditing, say, an insurance company, you cannot have a team which has no experience in insurance companies or something. And this, all this needs to be clearly documented, that you have gone through this process and spent that much time in terms of working sheets and others, that you have done a thorough audit planning which is there. The second obviously is audit execution, which we are all experts at. Now in audit execution, if you do a proper planning, execution would be smoother and focused. Sample selection can be more informed. Time involvement can be monitored. And typically about two-thirds of the time goes in this. 55 to 65. So about two-thirds of the time needs to go in audit execution. Again, to be documented per se. And the finally is audit reporting. We have seen that in a lot of private limited companies, you make the report first and then start doing the audit. And that's the experience, I believe, of a lot of us who are doing a small private limited company. You will tell the person you are free, only get the last year's report, change the dates, and at least get the report in place. We will do the audit later on. So, but however, your documents will have to prove that you have done all these three things. So, most aspects of reporting can be easily known if you do the planning and the execution systematically, and about 10-15% of the time needs to go into this. Now, when you go to this risk-based approach, when anyone today asks you what is the audit you do, you always say, I do a risk-based audit. Now, what is really a risk-based audit in very simple terms, even for a private limited company, even for a small investment company, you will have to follow these steps. When I say follow these steps, not only in doing the audit, but in writing down that you have followed these steps which are there. So understand the industry and the business model. So if it's an investment company, you should know what is the business model. Are you only doing investments? Are you doing trading? Are you investing in only securities which are shares, or are you investing in, say, FPIs, or are you investing in mutual funds and so on? What is your business model? Understand the regulatory and financial reporting framework, FRF as we call it. So what is the reporting framework? If it's an investment company, you may have the Companies Act as the reporting framework as well as RBI. RBI also will have a reporting framework. So understand the reporting framework which applies to your auditee company which is there. Third, overview the IT systems to find out what are the embedded controls. Now, even in the smallest of companies who is using say Tally or Zero or Zoho or something, you will have some controls embedded within that system. So understand what are those controls. Even things like whether any backdating is possible, what are the controls which are there. And now when you're reporting for an audit trail, this becomes all the more important, that what are the embedded controls and what are the IT systems which the entity is using. Once having done the first three things, draw up an audit plan, execute the audit, discuss findings with the management, and issue the report. Now, if you tell the new set of our article trainees or CAs, they will easily follow this. It is only our older generation who are not still well versed with this, but the new generation is quite fast in following this in that sense. So if you tell the new generation, please follow this, they would be very glad to adopt this, because they are used to a systematic approach in conducting an audit, and they may actually not be able to tell you a lot of things, but if you go and tell, follow this, they may come up with a very good audit plan and execution plan as such. Now we have just mapped here all your standards of auditing across these three buckets. What comes under planning, what comes under execution, and what comes under audit reporting. It could be multiple also, but use this to get your initial planning thing in place, that which standard do you need to use for planning, what is for execution, and what is for reporting. Okay, so all your 45 standards are mapped here like this in this table. Not taking you through all of them, but if you see, for instance, 330, it covers all the three. SA 330 is a response to assessed risk. So that is required in your planning also, you require that in your sampling also, and you require that in your reporting also. So it is there in all the three. So when you are using that particular standard, you will have to be careful, or at least the person who is doing the audit will need to be careful about this. Okay. Similarly, related parties, again there in all the three. You need in the planning stage, does the entity have related party transactions? That's the planning. Then in execution, if yes, how do I execute? Reporting, obviously there is a lot of reporting on related parties, and we will see some of it down the line also. Okay. In the reporting, most of it comes in the reporting aspect, the 700 series which is there as such. Okay. The other change which has come in standards on auditing is this SA 800 series, which has been introduced in last year. They are all effective April 24 onwards in that sense. All reports signed on in this manner on or after April 24. So you have SA 800, audit of financial statements prepared in accordance with special purpose frameworks, then audit of single financial statements and specific elements or items of a financial statement, or engagements on report on summary financial statements. Now, these are very specific standards which are issued. The formats of the reports are also very specific. Now, in case a client comes to you and gives you any of these three things and he says, give me a certificate for this, the certificate will not be correct. You will have to actually issue a report in terms of 800, 805 or 810 in that sense. So when you come to 800, audit of financial statements prepared in accordance with a special purpose framework. How do you use this? You have a foreign subsidiary where in a country where audit is not mandatory, but when it comes to reporting for RBI, they say I need audited accounts, because RBI doesn't accept your APR without audited accounts. Now, in a lot of banks, the lot of authorized dealer banks, they are accepting what we call FFC, which is fit for consolidation accounts. So you take the management certified accounts of that foreign subsidiary, convert them to say normal AS or Ind AS, and issue a report under SA 800, because that is with a special purpose framework which is there. Now that is accepted in lot of authorized dealers and the RBI also. Some authorized dealers of course say that this is not enough, please go and get things audited in that country, though not mandatory there. But in a lot of cases they would accept SA 800 report, and this applies almost to a lot of private limited companies also who will have subsidiaries or joint ventures overseas which are there. SA 805 is only if you are certifying or giving a report on a specific element of a financial statement. So if the banker or your client says that only for property, plant, equipment, I need a report about few things which are there, then there is a possibility you may need to use the format given by SA 805, which is there. And SA 810 is again a limited reporting which is there, summary financial statements. So you have a full set of financial statements, you just summarize them, and the client says, you give me a report on this, I don't want to give the whole thing, then you will have to give a report under 810. So 700 is for all your normal audit reports, 700 series. 800 series is all for your, as we call it, special purpose reports or AUPs, agreed upon procedures which are there, FFC or other things. So that's on the audit thing. You come to this MSME aspect. And again, a very important aspect as far as our current government is concerned, lot of focus on MSMEs, reporting on MSMEs, and taking penal actions on MSMEs. So there was a form which used to be there till last year, which form got revised. It is now called MSME Form 1, and that form has much more comprehensive disclosures with respect to amounts due to MSME along with their aging. The earlier form only had disclosure of only if there is a delay of more than 45 days, but this form is much more comprehensive and a lot more reporting comes in this particular form. It's a half yearly form. So 31st March form goes in 30th April and September goes by 31st October. Simultaneously, from this April onwards, the definition of MSMEs also has been, the thresholds have been almost doubled. So for micro, small, medium, they are now investment is 2.5, 25 and 125 crores, and turnover is now 10, 100 and 500 crores. Remember this definition. When we come to the non-corporate entities, the definition of MSMEs have a different threshold. This is a threshold mainly for corporate entities in that sense. Now this half yearly return which is given to the Ministry of Corporate Affairs, it says that all companies who get supplies of goods or services and whose payments exceed 45 days on the date of deemed acceptance of the goods or services should submit a half yearly return stating the amounts of payment due and the reason for the delay. Now this is a mandatory form. If you don't give this form, there are penalties for not giving the form. Now from audit angle or from a preparation of financial statement angle, you need to identify the process for identifying and reporting dues to MSMEs. So first of all, does the company have a vendor onboarding process where they are able to identify MSMEs? Now there are portals available. I think what is the name of that portal? Darpan something. Some portals are there where yeah, Darpan is for NPOs. This Udyam is for MSMEs. So you have to get yourself registered on that portal, then you will be an MSME. So find out what is the process the entity follows. Even a small private limited company will need to follow this identification process. If there is a delay beyond 45 days, which means whatever is given in that form which is filed, are they providing for mandatory interest? In 99.9% cases, interest is not provided for. It is only accounted as and when paid. But we have seen that in case of large corporates, especially multinational corporates, or in case of large audit firms who do the audit, they insist on a provision of mandatory interest. Though the company would never be paying that interest finally to the vendor, saying that they never asked for the interest. This is on mutually acceptable terms, or maybe the quality was still under process or something like that. So whether you need to provide for mandatory interest, and there are different types of disclosures which company give on if interest is not provided. There are disclosures as per schedule 3 which are mandatory for this. And you always have from last year onwards this tax provision because of a disallowance under 43BH, which you will have to look from a preparation tax provision or a audit point of view in that sense, including reporting in a tax audit. Again, here there are several views available that you don't cover traders, you cover only delays as on 31st March. Some people say that take my outstanding on 31st March and then consider whether there is a delay. So I think if you believe that the stand taken by the client is a very extreme stand, write that stand of the client in the financial statements, because that is always a better way to presented rather than saying that no, the client has done this and I have accepted that particular stand. We'll see more of MSME when we come to non-corporate entities. Now SEBI. SEBI, we are just covering two things, and one is this related party transactions. Every second day you get a news report about related party transactions. Now RPT governance is now central to boardroom agendas and regulators. And why is it important? Because disclosures and approval processes are to be looked at, arm's length validations and whether undue advantage obtained, or whether there is any tax arbitrage which is taken by anyone. These are three important things which everyone is now looking at. The aim is to protect minority shareholders and reduce reputational and financial risks. And you have the section in the Companies Act of misdisclosures and other things. And you need a effective RPT oversight to ensure compliance, transparency, and so on. Now, if you look at RPTs, for different aspects, there are different things available. So if I look at the definition of RPT under SEBI, it is different. Under Companies Act, it is different. Under Ind AS, that should be Ind AS 24. Under Ind AS 24 also it is different. So under what you are reporting, RPT is important. There is a possibility that say a typical example is say independent director. All independent directors automatically become RPT under Ind AS 24, but they may not be RPTs under Companies Act. So that's a very clear dichotomy which is there. A CFO. CFO may not be an RPT under this section 276, but he automatically becomes a RPT under Ind AS 24 and also under SEBI LODR now. Okay, so you will have to reconcile what is the RPT under which of the regulations which are there. So if someone asks us a question, is this a related party? We'll have to immediately ask under what regulation are you talking about? And you will have to disclose accordingly whatever is there. And today we have a lot of companies or lot of groups who carry out special audits only for related party transactions, and this reporting happens straight to the audit committee. And we have instances where we have done such reportings to the audit committee, and the RBI looks at these reports, especially in big groups. If it's say a fintech group or a finance group bank, they will look at the reports of RPT, whether the bank is also indulging in such practices which are there. Now, who is a relative? Again, different definitions everywhere. You may find that two brothers are not relatives under some statutes because one may not be able to influence the other in that sense. Materiality thresholds are different because there are a lot of thresholds of materiality below which RPTs are not considered very significant. So that thresholds are different under different statutes. The approval mechanism is different under different statutes which are there. And in this, I have still not put the GST and the income tax because that will again have its own different definitions which are there, which we will cover when we go to the other part of the presentation. Okay. Omnibus approval. We all talk about omnibus approval. Again, different things. It basically omnibus approval is there only in SEBI LODR. It is not there in the Companies Act or Ind AS. And as a best practice, it is suggested that you use omnibus approval only for routine transactions. Don't use omnibus approval for one-off transactions. There you go for the approval route which is there. Subsidiaries, lot of exemptions under SEBI LODR because they say as a group you are anyway reporting the transaction, but no such exemption may be there under Companies Act, even if it's a transaction with a subsidiary. Exemptions, again, different exemptions which are there, and you need to document the rationale for any exemption. Do not apply any exemption without any written justification because otherwise you will run into problems in the future, even from a ROC for private limited companies. Disclosure requirements are different. Who is a director, KMP, arm's length, everything there is difference in different statutes which are there. So you can, all the regulations are referred to here. All the sections are referred to here. So when you see, get this presentation and you need to get more details, you can easily look up those regulations of SEBI and the Act and the standards. So this is what is the minimum thing which is done. So minimum information to be provided and applicability metrics, disclosure categorization, ensure that the AC, the audit committee and shareholders have access to the data, certification from CEO, CO, CFO and the KMP and the standards to align with the regulations which are there. Now, this is something which is a chart which we have drawn up internally as to what is the approval route for transactions with the related parties under Companies Act. So, under the various sections, if you have a transaction, this is a chart which can tell you whether you need approval of the audit committee, depending on whether you are private or public, whether it can go under general approval, whether you need prior approval. And there's nothing omnibus in Companies Act, but there is a prior approval process which is there. Again, look at this chart, whether the board needs to approve, whether audit committee needs to approve, whether shareholders need to approve prior, after. There is always a ratification which is possible, but as auditors, if there is a material related party transaction which is not taken under prior approval and there is a ratification, maybe you may need to consider an emphasis of matter paragraph in your audit report which is there. This is the same chart but under SEBI LODR. So this would be a different way in which you analyze the transactions under SEBI LODR, because here you will have these omnibus approvals and thresholds which are different from the Companies Act. How do you determine ordinary course of business? And there is even a standard on auditing of 550 which tells you illustrations on what transactions are outside the entity's ordinary course of business. So besides SEBI, besides the Companies Act, you will also, and the secretarial standards which deal a lot about related parties. There is a SA 550 on related parties which also tells you what cannot be considered as an ordinary course of business. Then how do you determine arm's length? Again, you'll have to see the standards. There is something in AS 18 for non-Ind AS companies. There is something in Ind AS 24. There is something in SEBI, and there is something in the Companies Act itself. How do you determine arm's length? And over the last 1 week or 10 days, you have got something called industry standards on approval of RPT. Now, this is issued by SEBI but really applies to everyone, and they say if there is a material RPT, you need comprehensive disclosures. That is the last column which is there, and what you need to disclose, what does it apply to, and what is the threshold. If you have other RPT, in some cases it's comprehensive disclosure, in some cases it is limited disclosure. Now what is this comprehensive and what is this limited, we'll see shortly. Residual RPT. So three type of RPTs: material RPT, other RPT, but with a promoter or promoter group, and residual RPTs. Residual RPTs, that is only limited and minimum disclosures. But if it is material and RPT with promoter group, it is mainly comprehensive disclosures which are there. So comprehensive, limited, and minimum disclosures. Now what is this? Comprehensive disclosures is here. What is limited disclosures? It is all given in paragraphs A, B of that particular notification of SEBI which is there. A lot of things can apply to non-listed companies also. Okay, so comprehensive, limited, and minimum disclosures which are there. The second thing in SEBI which is relevant for us when we do an audit is this material events or information. Now, all material events or information has to go to the stock exchange within 30 minutes of the information given to the board of directors or that meeting. If it is the end of the day, then there is a timeline of the next day, but not more than 3 hours before normal, and this is there. Now, all this is very relevant because when we now do an audit, you will need to actually look at all the disclosures made to the stock exchange. If there is a penalty given, and we have seen cases where the company has given to the information to the stock exchange. Say for instance, there was this KFC store, and they have written to the stock exchange saying that there was a dustbin outside our store which was not in accordance with a particular design, and the municipal corporation fined us 5,000 rupees. That was informed to SEBI, the stock exchanges. Now that is irrelevant, but you will have to look at all these things because that was a very literal interpretation of that report, all penalties. But now they have luckily given us some thresholds which are there. But otherwise, you may find that my director was driving a car and the driver went through three red lights, and he was fined so much. That also may sometimes come to the stock exchange. So come to NFRA. NFRA, two important developments in the last year, besides of course a lot of orders which have come, which we don't get into that realm, but we are only going to talk about SA 600 because that affects all of us, and that's a big development which happened in the last year based on some findings in specific cases by NFRA. And BCA were lucky enough to have the chairman last year on in the month of October to speak to us on the next day after they released that notification on SA 600. They were here, I think, on 4th October, and this notification came on 3rd October. This was one of the few non ICI platforms where actually the chairman went and spoke to our teams. So what is this responsibility of principal auditor and the other auditors in group audits? Now, what was the earlier stand which were taking? I'm not talking about SA 600, whether institute's role is right or wrong, or whether MCA is right, or whether NFRA can do this. All that will settle down in its own time. But earlier, the stand we used to take was that if I am the auditor of a holding company, I accept the report of the subsidiary, and I mention in my report that I have accepted the report of the subsidiary and mention that as a other matters paragraph or something. I was not getting too much involved into whether the other person is competent, whether there are material transactions in that subsidiary or joint venture. I was not getting too much into it. It was more of a formality in most cases that I will accept things. Of course, in big groups, few auditors were actually doing a thorough process of getting reports and other things, the group audit questionnaires or whatever was being done in that sense. But now what NFRA said is that as the holding company auditor or as the group auditor, he should perform procedures to obtain sufficient appropriate audit evidence that the work of the other auditor is adequate for the principal auditor's purposes. So that is really based on the revised ISA 600, which is applicable internationally. In India, it is coming sooner or later. So now they say the principal auditor should perform all procedures to obtain sufficient and appropriate evidence that the work of the other auditor is adequate. Right of the principal auditor to visit a component and examine the books is also available in the Companies Act. It was always there. That is what NAFRA has reinforced. Consider the professional competence of the component auditor. The mere fact that he is a chartered accountant is not enough now. So if my subsidiary is, say, an insurance company and the person and the firm which is doing the audit does not have a experience of insurance company, he may not be competent, though it may be a firm of chartered accountants. That's what technically NFRA said, examine the competence of that other firm, which earlier we were taking for granted that if a chartered accountant, he knows everything, which is not the case now. The fact was anyway different earlier also, but now we are made aware of that fact. So inform the other auditor of matters such as areas requiring special consideration, procedures for identification of inter-component transactions that may require disclosure, and the timetable for completion of audit. Advise the other auditor of the significant accounting, auditing and reporting requirements and obtain a representation for their compliance. Principal auditor should consider the findings of the other auditor. So in other words, you become a super auditor where you are now able to direct the other auditor, maybe go and do the whole audit again, visit the other auditor, go and look at his audit working papers. Everything what you want to get the comfort is possible based on this inter or circular or notification which NFRA has issued now. And these are four things which you need to look at component auditors, whether the component auditor is independent. And you have to not only take a declaration, but you have to take a judgment yourself whether he is independent. Whether the component auditor has looked at a fraud risk. That is again something which you have to take from him. What are the internal controls and how is he evaluating internal controls of that component entity? And what are the risk of material misstatements? So if the component auditor says entirely or component is into trading of say chemicals, what is the risk he is evaluating when he is drawing up the audit methodology? Again, in other words, your audit plan, audit execution and audit reporting process of the subsidiary of the joint ventures auditor, I will have to look at. Okay, so that is what is becoming very important in that sense. And the responsibility of component auditors will be compliance with standards, evidence gathering, communication of findings, and collaboration. That is important now. Earlier, three things it was always assumed he was doing. Now he will have to be doing it much more thoroughly. But the last is important, collaborating with the main company's auditor, which is there as such. The only question which sometimes we debate and discuss is that if this new responsibilities of the holding company auditor has come, do you need a other matters paragraph in the audit report? We find that even with these new responsibilities which have been there and the holding company auditor doing everything, they are still including the other matters paragraph saying that we have relied on the report of the other auditor. I believe that's a contradiction. And sooner, there is only one company in India, I believe, which we have put in the BCA journal, which does not use other matters paragraph. I believe that's Reliance or something. They don't put other matters paragraph. The holding company's auditor, everyone else puts that paragraph. But that's a question you need to answer. We need to answer ourselves that if you're doing the whole process, are we not confident about everything? Do we still need the other matters paragraph which is there? Pardon? Infosys. Some one of those companies which we have reported is not putting that other matter. Is there in the one of the last year's September or October issue of the BCA journal? Correct. But as auditors, I think everyone says that why should I take a chance? Let us be safe and put the audit matters paragraph also. But that's clearly a debate. If you ask me, technically not required if you follow the instructions of NFRA which have come now. But I'm sure a lot of people have not even thought of this. It just goes on mechanically in that sense. Everything applies to everything. It applies to the branch auditors. You don't put in, there is anyway a separate clause in the reporting of branch auditors. But it applies to bank audits also. This audit committee interactions. Now, NFRA said that auditors are maybe not doing their job properly. Let us also educate the audit committees so that at least they will now tell the auditors, please do this, please do that, please don't do this, and so on. So they came up with audit committee interactions, and this is clearly based on the PCAOB series of education material which they provide to the audit committees in US and all US listed entities. They have come up with three series. One is on accounting estimates and judgments, where they have first talk about judgments relating to ECL model, expected credit loss, and the judgment pertaining to tax provisions. The second is on audit strategy and audit plan, and this is where you will need to be careful because as the audit committee, they can now ask you directly the same questions which are put in that series which are there. A lot of audit committees have now become wiser, saying that this is what NFRA has asked us to ask you. So please justify what you are doing in this. And the third is the audit of related parties. Okay. Now we'll go through each one of them in very brief. So in expected credit loss, the audit committee is told to find out these things. So auditor will have to be prepared for this when it goes to the audit committee. Then this is what is there for income tax under Ind AS 12. They are asked, how do you identify this? How do you recognize DTA? What is the evidence you have gathered? How do you take the tax rates which are there and so on and so forth? Then when it comes to audit strategy and plan, the NFRA interaction series has given that please ask the auditor about these things. So they will be asked what is the plan for communicating, how are you following independence, how are you following computer assisted techniques. In case of service organizations, are you obtaining type 1 or 2 reports? Group audits, what are you doing? What is the understanding of your risk areas? What are your key focus audit areas, areas of improvement, materiality, risk-based approach? Now, these are things which we covered right in the beginning when I said on audit strategy, you need to follow all this because this is all being asked on a regular basis now. And all audit committee members, they are now well informed as to what to ask for because of this particular things which are there. The third is on dealing with related parties. How do you identify related parties? How do you identify related party transactions? How do you ensure it is normal course of business? How do you identify it is on arm's length basis and so on? In lot of cases, they ask what is your identifier? In most of the cases, the identifier is the PAN. So the PAN becomes identifier for all your related party transactions. So which also means that whenever a director makes a declaration of related parties, you have to capture the PAN so that you can run that PAN in your SAP and locate all the transactions. That's the easiest way to identify transactions for with related parties. which means that your SAP will need to capture the PAN of those related parties. Anyway, you capture it for vendors and customers and all. Okay, so that is all about the corporate entities. Something which is relevant now may not be definitely for 24-25, but also something in the past also and going forward also. Non-corporate entities, we go back to that same chart because now the third one will be a little different. The third one is this non-corporate entities. You only follow the accounting standards issued by ICAI. For MSME, there is a selective accounting standard which are applicable with some relaxations. For large entities, all accounting standards are applicable. Out of this, 27 now. Okay, we are only talking about this 27. Now, there is one change in AS 22 which came last year, which is the ICAI standard, not the MCA standard, and that talked about Pillar 2 rules which have come in international taxation. So they are saying that Pillar 2 rules gives you a minimum threshold of tax in a group. So if there is a rate of 9% is that rate across all your group companies which are there. So across the group, you should have a minimum rate of 9%. And those are Pillar 2 rules which are there. Internationally, IASB has come up with an amendment to Ind AS 12 where all this has to come in. In India, that has still not been notified. But the institute has notified this for non-corporate entities. So this is not there for corporate entities. This is only there for non-corporate entities. I believe it will be very rarely applicable to a non-corporate entity, but it's still there. The institute in this case has been much faster than the MCA because it did not need any approvals in that sense. Effective date is 24-25. So if someone says, are Pillar 2 rules applicable to you in accounting? The answer is yes, but only for non-corporate entities. Now, you have this guidance note on financial statements of non-corporate entities, and we will call them NCEs, and it applies on or after 1st April 24. It applies to all entities other than companies incorporated under Companies Act and LLPs incorporated under LLP Act. So sole proprietorships, HUF, partnerships, AOPs, societies, trusts, statutory corporations, any form of organization involved in business or professional activities. It is applicable for preparation of all financial statements unless there is a format given by a regulator. Say for instance, you are a state society, a society registered under a particular state and there is a format given by them that will override this guidance note. If it's an autonomous body under say a ministry, then again it may override. If there is a guidance given by ICAI specifically on something like say a political party. So for political parties, there is a guidance note with the format of financial statements. So that overrides this guidance note and it provides you the formats of financial statements for various categories. There is a technical guide which was there earlier, which is superseded with this, and we'll see that there is also a FAQ given on the guidance note. Now, this MSME definition, which we earlier saw that turnover and investment limits are different for this applicability of standards to non-corporate entities. And here, definition of MSME is revised. MSMEs have to disclose that they have complied with standards applicable to an MSME, and an entity which became an MSME subsequently will not get exemptions. So if you are normally a large entity and later on become a MSME, then you don't get the exemptions. Okay, you can do the reverse. But once having given everything, you cannot come back to a smaller thing. Now MSME in this means a non-company whose debt is not listed, which is not a bank where turnover does not exceed 200 crores or borrowings are not in excess of 50 crores or which is not a holding company and other things. And large entities are anything which is other than a MSME for this. So these are accounting standards applicable to large entities. This is that whole list of 27 standards which are there, which applies to all large entities. These are standards which are not applicable to MSMEs. So there are these 5 standards: cash flow, segment, discontinued, RPT, and impairment, not applicable to MSMEs. And there are relaxations given in some other standards on the disclosures. Okay, so you'll have to read the relevant standard to see what are the exemptions which are given. But if you see here that RPT is given an exemption for MSMEs. that AS 18 you don't need to disclose as per AS 18, but when you do a tax audit, you will still need to follow that 48(2)(b) or something. Now, there are some additional requirements. If you are a MSME and you take the exemptions, write in your report, write in the financial statements that you are using the exemptions. If you don't write them, then you are not allowed to use the exemptions technically. So you write that you are a MSME as per the institute definition, and therefore you are using the exemptions. If you have qualified for an exemption but you no longer qualify now, then you start following the standards and disclose accordingly. You don't need to change the previous year things then. You just say that from this year you are starting to apply this. Previously not an MSME and now become a MSME, you don't get any exemptions. So if you opt not to avail the exemptions in respect of any but not all the standards, disclose the standard in respect of which you are taking the exemption. So selective exemptions are possible. If you opt not to avail any one or more of the exemptions, again comply with the relevant requirements and may opt for availing certain exemptions or relaxations with a particular standard not possible. So within a standard, everything you have to follow, but between standards, you can still have that option to follow or not follow. Now you got this FAQ on guidance note of financial statements. The first is a very obvious thing. All guidance notes apply only to the chartered accountants. They don't apply to the entities. So the non-corporate entity may very well say that all that is not relevant for us. I am still going to say present my accounts in the horizontal format and not the vertical format. So what does the auditor do? So in such cases, the FAQ says that you exercise your judgment in determining whether such non-adherence will result in a modified opinion as per the standards on auditing. I'm sure if it is horizontal, it needs a modification in your report, but some say one disclosure missed out, which may not be material, which he does not want to give, you may not like to modify, but use your judgment and maybe first try to convince the client that please give this, otherwise my report can get modified, otherwise use your discretion. Whether it is required to be applied while preparing financial statements of not-for-profit organization, the answer is no, because there is a separate technical guide for NPOs which needs to be followed. But you see whether you fall in that definition of NPO there, which is there in that technical guide. Can additional line items be given, or is it mandatory to strictly follow the items? You can give additional line items. This is in line with the Schedule 3 requirement also. If the figures of particular item is nil in both the years, can you omit it? Says use your judgment. If it is not relevant, use your, say for instance, provision for tax. If though it is nil in both years, I may still like to give it because it still gives important information. So use your judgment in that case. And whether comparative figures are to be given, the answer is yes, unless of course it's the first year. This is the format for financial statements for non-corporate entities. So you will have to start with owners, funds and liabilities. Whether it's a finance company, non-finance, a single format for everything, unlike Schedule 3 where you have three formats. Three formats are one for Ind AS, one for non-Ind AS and one for NBFCs. So single format starts with owner funds and liabilities, reserve surplus, non-current liabilities, current liabilities, the relevant note number, current year and previous year. Then the asset side, and we have just reproduced this as it is just for easier reading. So non-current assets, current assets. Then in the owner's partners fund, you will have to give all these things: opening balance, capital introduced, remuneration, interest, withdrawal, share of profit and closing balance, not just the two opening closing figures. This is something similar to what we have learnt in college. Then in profit and loss account, revenue from operations, other income, cost of materials and so on again. But everything is in the vertical format. There is no horizontal format now allowed. Profit before exceptional and extraordinary. Here they still use the word extraordinary, which is not there for corporates. Then before partners remuneration, after partners remuneration and so on. These are very specific things you will need to disclose now. If it's say a trust, then you can remove that line. But if in a partnership, you will have to add these things. Again, continued, discontinued operations are there. Then your classification of current and non-current. The same definitions which are there in Schedule 3 are brought in here based on your working capital cycle, operating cycle as they call it. You will have to decide what is current asset. So your asset classification will go on these four things. And your liability classification will also go on these four things, very similar to what we do in a company. And this is how your operating cycle from acquisition of raw materials to the recovery of money after the final production. So you can again change your operating cycle here and decide in my partnership balance sheet what is current and non-current in that sense. Say for instance, you have got lot of SPVs in a real estate group which are partnership firms. So there you can anyway change your operating cycle, say to a 2-year period if you believe that your properties take 2 years to complete. So your whole disclosure of current, non-current will change accordingly. You may like to put lot of things in non-current there instead of current. Rounding off. Rounding off is mandatory for corporates. It is optional for non-corporates. The rules are the same, but there is a shall in Schedule 3. It is a may in non-corporate entities. Okay. Then disclosure as per MSME Act. This also comes in the partnership firms now, what we also give in the companies or non-corporate entities. And also aggregate amount of receivables exceeding 6 months, whether they are secured, unsecured, doubtful, whether there is any allowance or bad and doubtful debts to be disclosed separately. This comes in for non-corporate also. The additional disclosure for employee benefits with a breakup, salaries, contributions, staff welfare. Again, that 1% or 1 lakh, whichever is higher threshold is there. Adjustments to carrying amount of investment, the diminution where you will now need to apply AS 13, which is there. Net gain or loss on foreign currency transactions, exceptional and extraordinary items, prior period items. You don't have a comparable Ind AS 108. Therefore, prior period would be allowed for non-corporate entities. There is no need to restate anything in a non-corporate entity. Expenditure on all these things, raw materials, store spares, power, rent, etc. again needs to be disclosed. Exceptional items you can disclose in corporate also and non-corporate also. Ind AS 1 allows you to classify something as exceptional, and so does for a non-corporate entity. And these are some examples. These are non-recurring, may be related to your business, but they are non-recurring, one-time or exception, something which is very heavy expense or income can be classified as exceptional. In the format also it's given. Extraordinary not allowed for corporate entities, but is still allowed under non-corporate entities. So maybe a fire, a company may say, I may take it as extraordinary rather than exceptional. They will have to be allowed because the format gives you extraordinary items. And to give an example, which I always give, when this World Trade Center, that plane thing happened, lot of banks which were in that building wrote to the IASB saying that we have got a massive damage because of this terrorist attack which was there. Allow us to classify that loss as extraordinary. And the answer given was that this terrorism risk is a normal business risk. Okay, so it cannot be extraordinary. Maybe you do it exceptional, but this is the level at which you have to risks have to be considered. This is a very extreme, but it's a proper example documented at that particular time. Now, this is the summary of disclosures. Left side is corporate, right side are the non-corporate. So in corporate entities, I will look at Schedule 3, Division 1, 2 or 3, whichever applies to you. There are specific sections where you need disclosure like 186.4, which is not in the Schedule 3, but you have to give that and you have to refer to that disclosure in the CARO report. Applicable accounting standards. So you have all accounting standards which give you lot of disclosures, whether it is Ind AS 16 or the payroll related thing, as per MSME Act and as per other statutes. If you are a company but also governed by RBI or IRDA or SEBI, other disclosures come in. When you come to non-corporate entities, you have to now follow the guidance note. There is a separate guidance note for LLPs also, very, very similar, almost the same thing. as per applicable accounting standards, those 27 standards as per MSME Act, and a disclosure for exemptions or relaxations. Now, this is a chart which I believe you have to keep ready for everyone who makes your financial statements and audits the financial statement. What is relevant for corporate and non-corporate entities? Some other relevant points in the last maybe 10 minutes which we have. So I said related parties earlier, we have not looked at other sections. So in the income tax side, you may need to look at these 2-3 things. And the last one is more important, the GAR provisions, which if you have a related party transaction, which may be otherwise disclosed, which may be at arm's length, but it can be still looked upon as a tax avoidance transaction. So please look at it from that angle also. From the goods and service tax angle, any RPT with or without consideration needs to be looked at. Even if it is without consideration, you will need to pay notional GST on it. Say for instance, you have a building and there are 20 group companies in the building who are using services who are running from there. The company which is owning the building will have to charge something as a shared service charges to the other smaller entities. Otherwise, there would be GST on reverse charge basis on the other entities, which you will not be able to claim as ITC also. Then in income tax, when you do an audit now or when you prepare financial statements, there are a lot of things which you can reconcile now. So for instance, when you're looking at contingent liabilities, I can always reconcile it with what is appearing in the portal of my account in the income tax. So ask the client that give me a dump of the entire year's liabilities or demands outstanding, or take the excess and do it yourself. Compare 26 ES for all credits. We have seen in a lot of cases that the credits have come and the corresponding income has not been booked. Now that is also something, in some cases clients have booked only the net amount. The TDS is not grossed up. So all that can be easily found out with these reconciliations. And the new thing which is now available since last 2 years, your AIS and your TIS. And for individuals, it is very easy to use this to file your returns, but for audit, again, this is important. If it is not made available to you, ask for it from a client that give me your AIS and the TIS. It's available for all SSEs. It will give you all transactions of investments made, properties purchased, sold, tax payments, corporate credit card payments, everything would be available in these statements. Just compare whether they are correlated with your books of accounts. When you go to GST, look at it from an output angle. From an output angle, you reconcile GSTR 1, 3B, goods moved to from job workers, whether FIRCs are there for all your exports. This is again relevant for FEMA validations. Sale, sale of asset. If it is within a period, GST may need to be reversed. The ITC claim may need to be reversed. Look at that. Ensure TDS, TCS claim matches with the turnover. When it is an input, which is basically the ITC, when you write off any stocks or assets, the corresponding ITC may need to be reversed. So it's not very simple to now, as a company or as an auditor, say that please write off these assets. They are no longer in use. You will have to consider the GST aspect also. ITC reversal on reclassification of revenue to capital. There are a lot of entries passed in finalization. There is always a GST angle to it now. ITC reconciled with 2B. Eligibility of all transactions where ITC has been claimed. Say like instance gift articles. On lot of gift articles, unless there is a branding, you are not allowed ITC. So you make sure that you put your brand somewhere. But Diwali gifts, typically there is no branding. So you may not get the ITC on those gifts which are there. ITC to be reversed in case you don't pay the vendor within 180 days. On RCM basis, whether your RCM discharge, say payment to lawyers, you may need to pay on RCM basis whether that is discharged. So scan your profit and loss account for all these things. Corporate guarantees, even if you have not charged on a corporate guarantee, GST will ask you to pay taking a 1% assumed guarantee fee. And if you do that, you will have a problem in transfer pricing. So better charge 1% and have the whole transaction proper so that your accounting is satisfied, your international transaction is satisfied, and GST is satisfied. Cross charge, look at it. Your credit and debit notes, and on CSR expenses, goods written off, destroyed, free samples, there is no ITC available. So make sure of this. Export benefits, verify all your application for refunds, ROD, TEP, that's the new form of benefits you get, drawbacks, whether you are following accrual or cash in this, because this is something you have to ask the client. And again, see the portal, because you may have lodged claims on the, this is again all online digital. So ask for all claims filed during a year. Whatever claims are filed, you need to accrue, because you will not file a claim and the claim will not be even accepted by the portal if things don't match there. So whatever is filed will need to be accounted on accrual basis. And how do you show it, whether operating revenue or other income? Typically, there is a both is possible. There are both views which are given, and companies follow both the things. So find out what is the view followed and what is done. In FEMA, when transactions fall under automatic route, whether appropriate authorizations are taken, whether all your forms which are required are filed, because that also will give you information about the foreign transactions, and whether any show cause orders or penalties have been again available online on the portals which are there. Take you through three important EAC decisions which have come recently, applies to everyone, corporates, non-corporates. One is on accounting of major spares. The query was that if I have a threshold of 5 lakhs and 1 lakh in case of critical spares, how is the accounting to be done? So the issue was whether useful life of spares estimated technically should consider the life of the intended machine where it will be installed or on a standalone basis. Now, in terms of Ind AS 16, it says that the spare part should be depreciated using its own useful life. That useful life estimated in terms of utility or to the entity, including both the period storage, use, and so on and so forth. So it can have its own useful life also, not necessarily linked with the life of the asset. Then in case of spare parts which are capitalized, what should be considered as available for use? When the spare part is actually installed in the machine, or it is only available as a spare? And the answer here was that once it is available as a standby, you start depreciating it. You cannot wait till it is actually put to use. And these are actual queries asked by some big corporates. And whether installation and commissioning expenses of spares can be considered or ignored. Typically, if these are not material, they will need to be charged off. But if they are material, you can add them to the spares and depreciate from the date they are available for use. The second and important one is on how do you classify doubtful debts no longer required written back. Now, the facts are that there were some 94 crores of which something was received and the other was written off. Now, when you receive a doubtful debt which has been earlier provided and now you receive it back, should I show it under other operating revenues or other income? The answer is neither. If you look at the answer, it says that when you provide for a doubtful debt, it is providing for an impairment of a financial asset. Now that impairment has to be on a separate line item as per the Ind AS 109 also and as per Schedule 3 also. Now when you have a separate line item provision for impairment loss, it also says in brackets including reversals if any. So this is nothing but a reversal of an impairment loss of a trade receivable. So it has to go in that same line item as a negative figure. It cannot go to other income or other operating revenue in that sense. Now this is something which I believe most of us would have rarely followed. Correct? But this is a ESC opinion which has recently come. And therefore I thought this is important to have be known to all of us in that sense. The third is how do you classify and present accrued wages and salaries to employees? Should you show it under current provisions or trade payables? The answer is again neither. It is other current liabilities. Okay, now this clearly also applies to a non-corporate entity. Other current liabilities, even that impairment thing applies because you have that diminution thing or something. So be careful of very simple things which are there where a lot of us would be actually going wrong. And ESC opinions are very useful from that angle. And a lot of ESC opinions are very simple like this, where on a day-to-day basis we have missed out on something. Okay, some just for a recap, some common errors which are noticed. This is from QRB observations, FRRB observations, and maybe our own experience. In corporates, non-disclosure of aging, secured, unsecured dues from directors, etc. Final amounts not tallying with the disclosure amounts. The notes not telling with this, disclosing share application as part of shareholders' funds. This is a big mistake. It has to be shown separately till the shares are allotted. Sometimes people do it to get a net worth certificate, but that is not relevant. For net worth, you can include it, but not for the disclosure. Cash flow statements not telling. Incorrect classification of short-term, long-term borrowings. Then details of immovable property not held in the company name. Shareholding pattern not properly disclosed. Formulas for the ratios not disclosed under Schedule 3. Reconciling cash equivalence is not done with the cash and bank balances. Definition of RPT not followed. In non-corporate entities, presenting in horizontal format. That's the biggest error which you will find. Tax provisions are missing. If they are missing, it's a certain modification in your report, because to that extent your profit is wrong. So it clearly involves a qualification in your report if there are no tax provisions in non-corporate entities. Employee benefit provisions, say gratuity is missing. MSME disclosures missed, not clear which accounting standards to follow. Then applicability exceptions of exception relaxations to the entity, accounting policy is not given, incorrect terminology used, cross-referencing not done, rounding off not done properly, and so on. And finally, this is what UDIN update has come last month, that whenever you take a UDIN now, you need to write whether your opinion is modified, qualified, adverse, disclaimer, key audit matter, emphasis, and other matters. Now, I don't know what happens if it's a qualified opinion and there is also a key audit matter, which one to click there, or whether you do multiple clicks over there. But this is also there in the new UDIN. And if you look at today's news report, there is a further modification going on. Say in tax audit reports, you will not be able to generate a UDIN for the 61st tax audit report. It will track how many reports you have signed. And they are also saying that we are also going to put something more in the UDIN, which is there in that sense. Okay. So I think that was it. I think we were just short by 5 minutes or so, but I think that's the, so it's end at the end ultimately. Fine.
We may take just maybe couple of questions first physically, and then couple of questions online. Mandar, our secretary, is online. He will take. So first, yes, Vijay.
LLP account and partnership firm accounts. So earlier what we used to do are two things, that provision for tax was part of my capital or current account. Okay, now the format says that provision for tax is part of P&L, only not net profit should go. And in reserve and surplus, there is one line item that undistributed profit, like retained earning there is in company. So is there any chance that partnership firm also have that this type of undistributed profit, or should partnership firm or LLPs partner should meet and decide, okay, that this much amount is to be transferred to capital, or directly I should transfer all amount to my current capital?
So I think first you will have to look at the partnership deed, what it provides, that what happens to the profit after paying the taxes. And if that clearly provides that you take it to a current account or a capital account, do it accordingly. Otherwise, you can always have a small resolution passed, or when you have a meeting, when you adopt the accounts, no, maybe you have a small noting done that this is what the partners have resolved to do. You may not need to amend the partnership deed for it, but just a small noting that the profits after paying the taxes and all, we are resolving it to transfer it to the capital accounts or the current accounts, whatever you want to do. Or you can take it to reserves also.
Okay, one more question. Yes, Dilip bhai.
In case of proprietary concern, that he has a business income plus other incomes also, then how to provide for provision for taxation?
So what we do typically is, no, we divide the accounts. So if you have a bank account, which is a separate account for business, we only apply this guidance note only to that business account. Whatever is personal, we segregate out of it. And then only maybe do a tax audit also of the business account. But if you take everything, then the whole guidance note applies.
I agree. My question is that how to provide for provision for income tax?
So you provide as per the slabs, which is applicable to that person. Or for the business then.
Yes, business income plus other income.
So what is your financial statement consisting of? Everything or only business?
Only business.
So then you provide tax as per the slab applicable to him with an appropriate disclosure.
Okay, with disclosure.
With an appropriate
Okay,
disclosure.
okay, that was the question.
Okay. Okay, one more, please. One more, last, because
Yeah.
then let's keep
This is
it.
a partnership firm. Can we apply the horizontal form for one more year or?
No, no, no. You can
No.
adopt it, but you will have to modify your report. The firm can adopt it, but as auditor, you will need to modify your report.
Yeah, in only auditing, putting a note will do.
No,
suffice
no,
the-
no, no.
Modification.
Okay. And especially in case of partnership firm and is a builder, can we still follow the project completion system of accounting and
So you will have
modifying the
to,
report?
you will have to follow AS7 read with AS9. Now, if that permits you to do so based on your facts, then it's fine with an appropriate disclosure.
Yeah, appropriate disclosure.
No, but then it has to be in line with AS7 read with AS9.
Okay.
Then it is, they allow both the methods. Even 115 allows both the methods. So you'll have to see which is applicable for with AS7 read with AS9.
Thanks.
Tangible assets classification for a small entity, they may not have the gross block type of things.
So you go ahead with some assumption, saying that the last year's thing is considered as a gross block or something. Go with some
Like the
assumption.
India's transition when we did.
Yeah, go with some assumption, which a note there
Yes.
below the table.
Okay, now I think Mandar, me couple of
Yes.
questions online.
Yes, Zubin bhai. Thank you very much. Thank you, Himanshu bhai. I'm yet to give you a formal vote of thanks.
No, first give the question.
I know. But there are a couple of questions. In fact, there are a lot of questions, but only two questions I will take up.
Yes.
First is regarding the fate of the technical guide on cash basis of accounting. So whether the professionals can continue to follow the cash basis of accounting.
I think should be still possible with appropriate disclosures as is given in that guidance note. Should be still possible, but you will have to give a lot of disclosures in that case, and you will have to even do a lot of reconciliations in that case with GST and your TDS things and all.
Okay. And the next question is, what is the applicability of these accounting standards on non-business entity or non-profit organizations, especially educational institutions, or some people
So it applies.
consider even hospitals as non-profit?
So it applies because even the technical guide on NPOs clearly says that the accounting standards apply to them. And the same set of 27 standards will also apply to them.
Okay. I think that is enough for the online. Zubin bhai, can I proceed with the...
Yes, just before that, I think before the vote of thanks, I think I would
Yeah,
request.
may I request Abhay bhai?
Yes. The chair.
Yeah, Abhay bhai to please come forward and hand over the special moment, real-time photograph to Himanshu bhai for this wonderful presentation.
Yes, Mandar, all yours.
Yeah, I also have
Announcements
a few announcements because, like this very interesting lecture meeting, we also are having another lecture meeting on the related party transactions disclosures on 6th of August 2025. Himanshu bhai touched upon a few aspects in his presentation. A more detailed version will be taken up on 6th of August. Then we also have a lot of study circle meetings lined up. So the study circle meeting on the finalization and review of the accounts from GST perspective will be taken up on 5th of August. This will be a hybrid hybrid and study circle where the physical study circle would also be possible and online will also be possible. Then another indirect tax study circle on 25th of July, use of technology for GST. So use of AI, how to use it, so that those things will be taken up. We have a direct tax study circle on mergers and demergers, key income tax consideration and case studies, which will be on 7th of August 2025. We have also a suburban study circle planned on 25th of July on interactive case studies on discussions on tax audit. Uh, our tree plantation project 2025 would be held on 2nd August and 3rd August. Then 29th International Tax and Finance Conference will be scheduled on 14th of August to 17th of August. So very limited seats are available. So those who wish to take benefit can enroll them at the earliest. All this information would be available on the BCAS website, and those who are the members of the BCAS can access it through BCAS Academy. With this, may I now come to the pleasant task of thanking Himanshu bhai for this wonderful presentation. I would say a kal aaj or kal presentation, a very futuristic presentation, power pack presentation on the subject matter which deals with the historical data, I must say. And you have wonderfully, lined up your presentation dealing with various aspects, dealing with a small aspect of, dematerialization of the shares, changes in the ADT forms. You ended it with a very minute aspect of UDIN, as to how the UDIN is going to, especially the 61st audit tax audit report, you have to be careful. That was the end. And in between, there were a lot of things like Ind AS applicability, the classification of the MSME, SEBI related disclosure, especially related party disclosure, or the audit committee interactions, NFRA, dealing with the component auditors, uh, non-corporate entities, the guidance note, AS22, and lot of various other aspects. You have also touched upon the audit planning, audit approach, and standards on auditing, such as SA 800, 805, and 810. So overall, it was a jam-packed, complete presentation. So I thank you a lot for once again coming here, as always, and sharing this wonderful knowledge with the audience. Thank you, Himanshu bhai. I request all of you to kindly applaud those who are physically present as well as those who are.
Thank you, Mandar. And thanks to the online participants also.
Thank you, thank you. And we have got a very, almost 700 participants were available online throughout the session. So
At maximum at any point of time.
yes. So thank you, Himanshu.
Huh? Because of? Yes. Thank you. Thank you.
Thank you.